Welcome back to another video. In this video, we're going to be analysing Uipath. Ticker symbol is PATH, listed on the New York Stock Exchange, and we're covering it today as it was the recent winner on the latest Patreon poll we did to vote on the next group of stocks that are going to be covered on the channel. PATH recently IPO'd and was met with a lot of hype and good expectations. Of course, the stock did very well because of this, as you would expect. But today we're going to uncover all of the hype and see if Uipath is worth taking a closer look. And to do this, we'll be reviewing the business model and operations. We'll look at the financials of the business and its economics. And then lastly, screen the stock in our DCF model with some assumptions to see how well priced it is today, or come up with our own target price or fair price in case we do get an opportunity to buy down the line. So firstly then, what is Uipath? Well, they are a leading enterprise automation software company that helps organizations efficiently automate their repetitive day-to-day tasks and business processes. They do this through their robotics process automation, or RPA software, which actively monitors users' activity and learns how to execute those tasks automatically upon request. And this is done through AI computer vision and machine learning tools. Very fancy, I know. But coming away from the dazzling dynamics of their product, they do have a very strong and sticky business model. As you would expect and should be happy to see, they sell these products on an annual subscription basis, which can be hosted on any public or private cloud server, so increasing the addressable market that they have. The pricing is also tailored to customer-specific requirements, as they do work with a large number of diversified customers with differentiating needs. And if you needed more proof that Uipath's sticky business model and quality product is leading them down the road to success, look no further than their KPIs. One I want to point out is the 145% net retention rate. And that's dollar-based retention. But what that's telling us is they are not only likely retaining close to 100% of their customers annually, but those customers are seeing the positive effects of deploying Uipath's automation solutions and have chose to either expand their range of usage or spend more on maybe different products. And you only tend to see retention rates as high as this with the most quality and unique software solutions. I think even CrowdStrike, who we covered, was slightly less than this at around 120%. To go with that, they've also got 95% gross margins in their core software business, which means it only costs them $5 to make $100 in sales. Again, something only seen in very unique businesses and very unique business models. And lastly, for a company that is still very much in its early development stages, they're still a very infancy stage company. They managed to reach, though, a free cash flow positive number of around 4% in the most recent year, whilst investing heavily in R&D and most likely sales and marketing as well to promote the product. But I guess we shouldn't be surprised given the extremely high gross margins that we've just looked at. But it's still great to see at such an early stage and gives us a good amount of confidence, or at least me, a good amount of confidence that the path to profitability should be a fairly easy one. Now, what's also quite interesting is the amount of Fortune 500 companies who currently use Uipath. There are some of the biggest companies with the most resources and possible options in the world that are choosing to use this company. And the fact they're choosing to use Uipath is a credit to them and tells us even more about their effectiveness and potential for growth, given these companies have very deep pockets and probably have the highest standards of all companies in the world currently. Now, additionally to this, if we just look at the way they've been able to drive customer revenue up as well in some of the most demanding fields. All of these industries here require efficiencies for different reasons. Pharmaceuticals for reasons to do with complexity and no room for errors. Logistics and automotive, more to do with frictional costs and margin pressures. They've been able to see, and obviously public sector as well, which is driven by frictional cost and efficiencies. And they've been able to 69x and 32x customer spend in some cases in some of these industries. And these are some of the most biggest industries in the world with much more room to spend than the low millions that they are currently spending with this company. And taking a wider view of the situation, the realistic addressable market for software robotics, we'll call it, is still in its early stages for obvious reasons. It's been growing rapidly over the past few years as businesses have become more and more aware of the solutions that are now available to them in this day and age. And through research done by IDC here, Uipath see that their addressable market is set to expand from $17 billion currently, which by the way gives them around 3.6% market share, to around 30 billion by 2024 and 50 billion further into the future. A 3.5 times in market opportunities in a relatively short period of time. If that's not a secular tailwind, then I don't know what is. And look, it's no secret to anyone that robotics and automation in general, software, combine that, they're all going to be very big parts of the world in the future, and their markets that are set to grow very rapidly. So all of that I've mentioned and all of this will probably be the main reason why the company currently has a market cap of 38 billion, which is around 60 times sales currently. Very rich, especially for a bargain hunter like myself. But with revenue growth averaging 100% over the past 2 years and 80% in the most recent year, there's an argument that they can grow into this valuation. But just to give you an idea as to how I look at companies at face value, from a perspective of an investor who is looking for high returns at relatively low risk factors, a quick reality check is how can this business 3 to 5x its market cap or market value in 5 years? This would give you an annual return of anywhere north of 18% to 25%, which is the holy grail for me and all investors in general. Now, if it's easy to see that path and you can realistically explain which assumptions get you there, then probably you have a good investment opportunity on your hands. Even if you miscalculate slightly, you've set the bar high enough that you will do very well. And more importantly, probably beat the market or alternative investments that are out there. But for Uipath, that would mean a market value of anywhere between 115 billion or 190 billion in 5 years. In other words, a huge business, especially if valuations have calmed down by 2025 and we're not seeing some of the crazy valuations that we see at the moment. So I'm not totally convinced that they can reach either of these values in 5 years, although they possess some very clear qualities that will help them get close or maybe to that size someday. But I did say that I would screen the stock with some assumptions of my own and come up with a potential fair value for the company today. And that's what I've done here, as you can see. And here I've taken their current growth rate for the next 2 years, which they've done in the previous 2 years, dropped it down to around 50% for the remaining 3 years. And that's a 62% 5-year average growth rate. And without going into too much more detail, you can pause the video if you want to look at any of the assumptions, but they're pretty straightforward and verge on realistic in my opinion. But my fair value is going to be a distribution of values, as you can see here. And the reason being is because of the profit margin possibilities. And this is important because they really do alter the fair value number. Because of their 90 to 95% gross margin profile, it would be reasonable to estimate they can reach between 30 to 35% profit margins. That's the case with some of these early companies. You can look at what their gross margin is, and usually that suggests how profitable they can be on the bottom line. If you start to see 50%, you'll start thinking of a low single digit to maybe 10 to 12%. Once you start getting above 80% gross margin at maturity, you're guessing that they can be anywhere between sort of 25 to 35%. In this case for Uipath, they're up in the 90s. So I think 35 is fair, but it does alter the fair value somewhat. And also we're only talking about 5 years down the line. I don't know whether they're going to be focused on profitability or whether they even should be at that point. So we're going to do a distribution of values. If we go with 30, we can see that the share price or fair price is $54 per share, $55 per share, around about, or 29 billion as a total market cap. Now, if we boost that to 35%, then our fair value is coming out as $62 per share, or 34 billion for the whole company. So my distribution, my fair value distribution, is anywhere between $55 to $62 per share. We're currently at $74 per share, so some way off, a little bit off at the moment. By my estimations, the stock is around 18 to 25% overvalued as an average. This isn't ideal, but remember, it's an IPO, relatively new to the markets, means that it should be relatively volatile in nature. We could see some sharp drops in the future, and at least now we have a good idea of an attractive entry point for the stock based on what it can do in the future. And that just about does it for this video, guys. As always, I'm going to leave this spreadsheet for everyone to view on the Patreon, so go and check that out if you're interested in supporting the channel and getting access to a bundle of valuations on some very in-demand stocks, plus some other benefits as well. I'll leave a link in the description for anyone who's interested, and I'd appreciate If you could leave a like on the video if you enjoyed it, and subscribe to the channel if you haven't already. I'll see you all in the next video. Good luck with all of your investments.